I'm with Damian Collins, Chairman of Westbridge Funds Management. First of all, Damian, welcome to Cape Schanck.
Great to be here.
Thank you for participating in the Inside Network's Alternatives Symposium.
It's been a great day so far, learning lots, so good to be here.
Damian, your research shows that asset selection drives the majority of performance outcomes. How does this shape the way you prioritise sectors and locations when you're building portfolios?
Well, it's still really important to pick the right sector because that's the tailwind that certainly gives you a good head start. So our research starts very much from the top down, looking at what sectors are likely to be benefiting from population growth, looking at the sector growth itself versus GDP. Is there more spending in that space that's going to drive the real estate performance? Technology change, how's that going to impact those particular markets? So a whole variety of things to get down to the right sector first. That's still important, but then within that, you're choosing the right asset becomes absolutely critical, and that can be as much as 67% of the total return that you're going to get is based on the asset selection. So very thorough due diligence program, selecting assets that are going to be in strong demand regardless of the market conditions, choosing locations that have limited supply.
Yep.
And so there's a whole variety of things you've got to go through, but the asset selection absolutely is critical, and also so is the sector selection.
You have particularly strong conviction in sectors such as industrial, medical and low-cost retail. What characteristics do those sectors share that make them such strong and persistent sources of alpha in your view?
Well, the industrial market's certainly been a strong performer over the last decade, and I still think that's still going to continue. And the reason for that is we're still seeing that transformation from a distribution model to online retail, and that's really driving logistics. People want their goods delivered, they want them quickly, and so the vacancy rates are incredibly low. We can't keep up with demand, so that's going to continue to drive that outperformance certainly for the next 5 to 10 years. In terms of retail, it's still very selective though. So in terms of the whole distribution channel, the retailers want you generally to come to their store. So we like the neighbourhood centres, your Coles, your Woolworths, where people are certainly coming there to pack and pick up their goods, but even now click and collect is the model for the supermarket. So they're also low cost. They generally run at 2 to 4% of their turnover goes on rent. So that's still a sector that's going to grow and perform well. And large format retail, again, low cost of occupancy for the retailers. That's critical. Anything that's too high cost in terms of occupancy for retailers, all that's really likely to see is more push to online, but the lower cost retail sectors is still a critical part of that distribution channel. And medical, we've just got those incredible tailwinds behind us of the ageing population. People, unfortunately, as they age, demand more medical services, got a population growth, and there'll be new medical services that we don't even know about. They're going to come into play. So they're the three key sectors that we like.
So within that medical property core focus, what are the structural tailwinds that are making primary care real estate particularly resilient across cycles? And is primary care, are those drivers different for other areas of medical property, or is primary care on its own in a sense in terms of its characteristics?
Well, yeah, they can be quite different, the sectors. So a private hospital carries its own unique risks because that asset is not easy repositioned. So we like the primary care model where there's generally a GP practice or as one of the core focus, and then you've got the ancillary services around it, the pharmacies, the radiology, the pathology and those other services. That drives people to come to those centres and they use the ancillary services. Tenants in those locations are generally pretty sticky. They know where their GP is, they like to go there, so the tenants don't like to move, which helps with managing and increasing the rents. And also they're hard to replicate because often they take up a large parcel of land. Often you can only get generally 30-35% site coverage due to the parking requirements. So you really need a big parcel of land to get one of these centres. So that supply certainly really does help. And also, of course, that continuing growth in demand for medical services is just going to continue as we age, more comorbidities, more medical services. It's growing at 5.5% compound annual growth compared to GDP at 2.4%. So that just all those structural issues mean that there's going to be more demand for medical property.
Is it almost an asset class in and of itself now, or still a subsector of a bigger asset class?
No, I certainly think it's its own sector now. Now, it's not certainly anywhere near as big as your office, your retail and industrial, But having said that, with the growth in the demand for medical services and what we're seeing, it is its own unique sector. It's got its own characteristics. It's historically been far more resilient to downturns compared to other asset classes in the GFC and other times we've had economic downturns, just because of the non-discretionary nature. People keep using their medical services generally regardless of the economic conditions. So it's a niche sector, certainly. It's not something you'd put all your investments in, but certainly for anyone looking to invest in real estate, having exposure to a more resilient sector like medical and healthcare is certainly something worth considering.
And Damian, for advisors who are here at the Alternatives Symposium or watching this clip, what are the really key features they should be looking for when they're trying to assess what's a high quality medical real estate exposure versus a lesser quality one?
Well, certainly looking at those fundamentals of firstly finding the manager who knows what they're doing. It's a specialised space, so a lot of people dabble in this sector. So looking for a manager who's got exposure to the healthcare sector and is particularly targeting, has done their research. But then in the individual asset selection, quality medical facilities, you don't want to be buying those old style ones. The medical service providers want to have good quality properties, generally near, also importantly, near hospitals. That's certainly a cluster that we're seeing where medical services around those hospitals, and certainly assets that are focused on where there's limited supply. It is harder to bring these on, so if you've got lots of land supply around, that's a risk. And looking at those assets that have got limited supply, and importantly talking to the manager about replacement costs. If the replacement cost of the asset you're buying is below what replacement cost might be, then you're less likely to see competition anyway. So really manager first selection and understanding how the manager goes about choosing their assets in that class.
Damian Collins, Chairman of Westbridge Funds Management, it's been a pleasure speaking with you and having you here with us at the Inside Network Alternatives Symposium.
Thank you.